After a decade entrenched in the startup world as a CFO, I've recently noticed a really seismic shift. $500 billion titan is venturing into our startup domain, and today I want to unravel what this move signifies for us fellow startup founders. What's up, everyone? Your favorite CFO, Logan here from Forecaster. Now, if you're a founder looking to fundraise anytime in the near future, you're going to want to watch this video. JP Morgan recently announced the launch of their Capital Connect product geared towards helping earlier stage companies raise capital. Now, this is a really major departure from their core investment banking business focus of working almost exclusively with much larger companies, and it's a signal to their bullish outlook on the general venture ecosystem. Now, this announcement came in October of 2022, and I personally have been able to get a look inside of their products. So today I want to talk about my 3 biggest predictions for how this might impact the venture ecosystem over the next 5 to 10 years. But first, do me a favor, hit the subscribe button so I can bring you more CFO insights on what's happening in the venture market. But for now, let's dive in. The first potential impact that I see happening over the next 5 to 10 years is going to be increased liquidity into the venture market. Now, I think that this is going to happen primarily for 3 reasons. So one, there's going to be less barriers for transactions because of the increase in technology. So the Capital Connect platform is an online tech-enabled platform, which makes it really easy for individual startups to go create a profile, input all of their metrics, and it just really lowers the barrier for the fundraising process generally. You're not necessarily having to go up and set up a bunch of different meetings, work on expanding your network. It just really makes the entire process a little bit more transactional. And because of that, the barrier to go into a fundraising environment is much lower. So the lower barriers for transactions is going to really flood the market with a lot of startups that are raising money. And similarly, because it is a much lower barrier to get into the fundraising market, you're going to have a lot more people that are interested in deploying their own dollars into the venture-backed ecosystem. So high net worth individuals, maybe smaller venture funds, are able to step up to the plate and get a lot more deal flow because the barrier to entry is going to be significantly lower. So the second reason that there's going to be an increased liquidity in the venture markets is because of the flow of information. So there's going to be a steadier flow of information that is going to allow private companies to trade much more like public companies. So if you look at the public equity markets, if you want to get any bit of information on any company, the financial statements, any of the managers' sentiments on the outlook of the industry, all of that information is publicly available. Now, if you're a startup or a private company, aggregating and synthesizing all of that information is overly cumbersome to become a publicly traded company. The rights to information that public investors have is sufficiently high that makes it very difficult for privately owned companies to hit that minimum bar. Now, in an online integrated platform, because most of our data is online anyway, this could allow for a steady stream of real-time information to flow between private investors and private companies. So because of that, private companies can start to look and trade a lot more like public companies in the future. So you might even be able to have a private stock exchange that allows private companies to trade much more like public companies if in fact you can control that flow of information and have a low bar of auditing. Now, this is more of a theoretical future. This may not happen, but I predict that in the future, these private companies are going to be able to trade stock just like they do on the public equity markets. And I believe JP Morgan's entrance into the space is one step into allowing that to happen. The third reason that there's going to be increased liquidity in the venture markets is because there's just going to be more eyeballs and more interest on the venture space generally. So people who have never really thought to invest in startups now might consider it because a major player like JP Morgan, having entered into the space, now validates that and now creates perhaps a net new asset class to people that otherwise might not have looked at investing in the space. So JP Morgan controls a lot of assets. There's one stat that cites that they control 1 out of every $3 in circulation. So because they manage a lot of money, this could be a good way for them to deploy private investor dollars that have otherwise never invested in the venture capital into the venture ecosystem. So more eyeballs on the space could lead to more dollars flowing into the space simply because a logo like JP Morgan has entered in. The second byproduct that I see playing out over the next 5 to 10 years is that there's going to be an increased attention in this space from other massive companies. Now, again, I think that this is going to happen for 3 reasons. So reason number 1 is that people pay attention to what industry leaders pay attention to. Generally, if a major titan like JP Morgan is paying attention to the venture ecosystem, a lot of other people that look and feel like JP Morgan are going to start paying attention to the venture ecosystem as well. So we've already started to see this play out a little bit. So one example of this is Fidelity, who recently acquired Shoebox, which is a cap table management software, in their efforts to start paying more attention to the venture-backed ecosystem. Generally, if a mammoth like JP Morgan decides that they want to invest in a sector or a portion of the market, other people are going to look at them as a thought leader and they're going to follow along in their footsteps. Secondly, other companies are going to need to pay attention to the venture-backed space because it's going to force them to remain relevant for their customers. Now, competitors to JP Morgan really aren't going to have much of a choice here, in my opinion. They're going to have to enter into this space in an effort to simply remain competitive. If customers care at all about getting their dollars flowing into the venture-backed ecosystem and JP Morgan scratches that itch for them, but others don't, then by sheer necessity to survival, other companies are going to have to follow suit and enter into the venture-backed ecosystem as well. And the third reason is forced relevance to employees. So this is similar to the second reason, but in this case, it is to attract and retain talent. So if I'm working for a company and I see an innovator like JP Morgan that's entering into the startup ecosystem and the company that I work for isn't, then I may decide that I want to go work for a more innovative company. People tend to want to work with cutting edge companies doing cutting edge things. JP Morgan being on the forefront of going into the venture-backed ecosystem signals that they are in fact being cutting edge, and that can lead to a problem for competitors who choose not to enter into that space. The third major theme that I see playing out over the next 5 to 10 years is an increased competition while fundraising. Now, this can be good or bad, but I think that it's going to play out for 3 reasons. So reason number 1 is that there's going to be a lot more noise while fundraising. And by that, I mean smaller companies with very little traction, very little data trying to get early rounds done. And more logos means that you need to do more to stand out. So because there's going to be a flood of people that are on the Capital Connect platform trying to raise money, you are going to have a lot more people that are pining for those investor dollars, and that can lead to a lot more competition. Now, a second byproduct of this is that if fundraising is done through a platform, it puts people on a more equal playing field. So having a really strong personality or a really mammoth network is going to have a much smaller impact on fundraising if everything is done in a standard transaction on a Capital Connect platform. So you really have to have something special to stand out because it's all standardized, and the Adam Newmans of the world have a hard time negotiating outsized valuations if everything looks the same and you are doing everything through one standard platform. And because of this, the third byproduct is that metrics are going to become significantly more important because personalities are taken in large part out of the equation, and the investor frenzy of having a big network, again, that is significantly dampened. So the companies with the strongest metrics are naturally going to rise to the top regardless of founders' networks or sparkling personalities. So I believe that metrics are going to become significantly more important now that major players are starting to enter into the space. So those are the impacts that I predict for this $500 billion company crashing into the cozy venture ecosystem, and to increase liquidity, increase attention, and increase competition. But I'm curious, how do you think it's going to impact startups in the near term? You can go ahead and add your comments below. I'd love to hear everybody's perspective. And if you want to hear more of a CFO's take on current events in the venture ecosystem, I'm going to be dropping a ton of free content here on YouTube. So go ahead, like this video, subscribe to my channel, maybe even hit the bell. And if you want to learn more about fundraising and how metrics and finance can help you run your business better, head on over to Forecaster's website to get in touch with a member of our team. But until then, keep building. We'll talk soon.